indexed annuity versus a fixed annuity versus a variable annuity. What is an annuity? An annuity provides a monthly income payment for life. Okay, or for a period certain, for 10 years certain, or 20 years certain, or whatever. It's a payment. It's issued by an insurance company. You either have a single premium, immediate annuity, which means you deposit a lump sum, say $1 million, and start taking an income of $5,000 a month immediately, or a single premium deferred annuity. You make that $1 million deposit, and you don't take an income for the next 10 years, then you start taking it, so it's deferred for 10 years. Or you'll have a flexible premium deferred annuity, where you can make periodic deposits, investments, contributions to it. You can add to it each month, or every week, or every day, or whatever. But it's a flexible premium, so you can add to it versus being a single premium, one-time lump sum, either immediate or deferred. If it's flexible premium, it's going to be deferred. Okay. Now, a fixed annuity will pay a fixed interest rate. Boom. Period. An index annuity doesn't pay a fixed interest rate, and it's not in the stock market, but it's following the indexes. You've heard of the indexes: the Standard & Poor's Index, the Standard S&P 500 Index, the Dow Jones Industrial Index, etc. Those are indexes. So versus being invested in the stock market, you're following the index. If the index does 8%, you got 8%. Simple. Now, then you have what's called a variable annuity, and the money there is actually invested in the stock market using mutual fund managers to manage the portfolio. Look at a piece of cake, at a big pie or a big cake, cut it up into a bunch of pieces. Each slice is a different sub-account managed by a different portfolio manager, a different mutual fund manager. It might be managing an aggressive growth fund, or a growth fund, or a growth and income fund, or a balanced fund, etc. Then you have the fixed account. If it's a fixed and a fixed/index annuity, that means you have the fixed side and or the index side. Now the indexes will do, you'll have to read each product to learn how one's different than the other one, but an annuity is an annuity. Fixed annuity is a fixed annuity. Indexed is indexed. It's just a matter of learning the bells and whistles that makes one company's, one carrier's annuity different than the other carrier. One pays a higher return. One pays a higher upfront bonus when you join in. One has a higher or lower surrender charge. One may have a 5-year surrender charge versus a 12-year surrender charge. Those are the little things that make up the differences between your different annuities, but you just have to learn your products. And the only way to do that is the carrier. You want to go with that particular carrier, learn all their products, ins and outs of both sides, the same as your next carrier. You might have 10 carriers. Choose the ones, if you know the products and how they all work in the bells and whistles, you'll know the difference for customer A versus customer B, based upon their personal scenario and circumstances. Okay? Now, life insurance. You pay money into it, you die. It pays somebody a lump sum of cash. That's life insurance, all right? Now, you have term, just pure death protection. And you have different types of term. 1-year term, annual renewable. Each year at your new age, it renews at your new price. Because you're a year older, the price goes up a little bit per thousand each year. Then you have a 5-year term. The price stays level for 5 years, and then it goes up. 10-year term, 7-year term, 12-year term, 15-year term, 20-year, 25, 30-year terms. Term to age 100. Decreasing term. Those are normally for mortgage protection type things. Those are your different term policies. Then you have whole life. You pay the premium your whole life. The first 3 years, there's no cash built up in it for you, but after 3 years, it begins building cash value. They used to say it was a return of premium, is one way of looking at it. Dividends is what, but different things has been called. And all throughout the years, it was either the whole life, various versions of it, or it was the term, various versions of it. And in the 1980s, people got smart finally in the industry and made the one change that happened in the life insurance industry in the last 100 years, and they started what's called the universal policy. Universal. Well, what makes it universal? It uses the best of both worlds. It takes the low-cost term insurance using the lowest cost term insurance available, which is annual renewable term, because you'll never be that age again. You can never buy it less than that. But each year the cost goes up a little bit per thousand. But it takes that insurance portion and combines it with a cash value buildup like the whole life policy. But instead of waiting 3 years to build any cash, it begins month number 1. Your money comes in, the premium. They deduct your cost of insurance. They deduct your policy fee. They deduct your admin charges. They deduct the mortality fees. What's left over is your cash value beginning month number 1. And you're following the index, so whatever the index is doing, that's what you're doing. Cool, not bad. And you're not invested in the stock market, but your feet are not nailed to the floor with the conservative returns of a fixed account at an insurance company or whatever. All right? And a bank CD, there's no way you compare those interest rates. They can't even touch what the guaranteed minimum on an IUL policy is like. It'll never go below 3.5%. How can you lose? All kinds of things. Learn your products. That's number 1. Number 2, if you're one of our registered representatives on the broker-dealer side, as well as one of our insurance agents, now we can get you into things you probably never even dreamed of, man. We'll get you in through Teachers Union, but you have to be registered with our broker-dealer in order to do so. Either a Series 6 or a Series 65. You know, Series 6 for mutual funds and variable contracts. A 65 for the investment advisor rep. One of those 2 licenses, and we can get you in, not only just get you into schools, but the unions will introduce you, okay? And you're a union rep. That's gold mine, folks. But you can't do it if all you have is an insurance license. You can work the schools. We can get you preset appointments. We can give you hot leads. We do it every day. Our internet marketing system, our phone room, doing the follow-up calls, our outgoing emails to remind people about their appointments before you show up. You make a follow-up phone call, introduce yourself before the appointment, make sure you remind them about the appointment. All right? Teachers forget. Anyway, that's part number 2.